How you doing? Steve Peterson here, and today we want to talk to you about group investing and opportunity zone funds. Now, opportunity zone funds are the hot thing now. It's June 2020, and so over the last couple of years, people have been talking about opportunity zone funds. The reason I say it's hot now is because the deals are happening, properties are closing in the opportunity zone fund structure. However, group investing has been around for years, and an opportunity zone fund is just another way of putting capital together to go acquire property. And so it's something that I think is very, very important, especially as we talk about moving post-pandemic and with a lot of shifts going on in the economy, not just shifts within the economy, shifts within the way we do things, right? And so a lot of people in coming out of, maybe lost their job, shifting, changing careers, companies, maybe we're doing one thing, maybe they're now shifting. And so opportunity zone funds allow for people, who are experiencing a capital gain. So let's just say you sold some stock, maybe made some money in the stock. Let's just say you sold a company, you sold a valuable, you sold something other than real estate and you made a capital gain. You can invest that in an opportunity zone fund structure that then goes by and buys real estate, and you can defer having to pay the federal capital gains. Now, in the state of California, you still have to pay state capital gains, but federal capital gains, which is 21% and above, but starting at 21%, you can defer having to pay that. So that's an excellent way to get into real estate when say maybe you had some money from, let's just say maybe a 401k and your employer, maybe you got laid off and you want to say, hey, maybe this is my time to take those funds and do something entrepreneurial and get into a real estate investment deal. This can be an excellent structure. Now, for people who are selling real estate and want to buy into more real estate, this is also an option for you to defer capital gains. Typically, we're used to 1031 exchanges being our only way to defer capital gains in the real estate business, but now opportunity zone fund structures allow for that. So I'm going to talk about three things that I think are very important in terms of group investing into opportunity zone fund structures. And number one is the investment has to be set up as an opportunity zone fund. You can't just simply go out there and purchase a property that's located in an opportunity zone. It does have to be located in an opportunity zone, but there has to be a fund structured, a legal entity with the right documentation set up as an opportunity zone fund in order for that to be a qualified deferral of the capital gains. That's the number one thing that I think is a big, huge misconception, is that people think that you can just buy a property in an opportunity zone and not have to pay the capital gains. Not the case. You have to have an opportunity zone fund structure. So that's the first thing I want to talk about is the structuring. Now, I think also to go take it outside of the world of opportunity zone, just in regular group economics, you've got to have the right entity structured in order to have multiple investors, multiple partners. And typically LLCs are the best way to go about doing that. And that's real basic. Many of us know that. But what's interesting, I just came across a situation where the property was owned as joint tenants. Not the best way to hold real estate, okay? Very, very difficult way to hold real estate. You gotta have an entity, and LLCs are the best entity really to have group investments. Now, if someone is doing a 1031 exchange, coming out of an exchange, that individual needs what's called a deeded interest into a property. So let's say you have an LLC, you're putting together a deal. This is not opportunity zone, but you have an LLC and you're putting together a deal, and you're going to take on an investor who's coming out of a 1031 exchange. That it can be through the LLC, but there has to be a tenant in common agreement, and that investor has to have a deeded interest at whatever percent that you guys, that you negotiate, number one, and that matches up with their 1031 exchange requirements, number two, and they have a deeded interest into the deal. That's a huge difference from an opportunity zone structure. So I wanted to point that out because a lot of people are looking at this as alternative to a 1031 exchange. and there's some definite nuances that you need to be aware of. So if you are exchanging into an LLC, a group investment deal, you need to have a deed of interest. Someone who's going into an opportunity zone fund does not need to have a deeded interest into the property. They will be vested through the fund structure and that LLC structure. So number one, make sure that the fund is set, the opportunity zone fund is set up and it's set up right. You can't just go purchase a property and then, think it qualifies. It don't work like that. Number two, property still's got to make sense, guys. Property still has to be a feasible, suitable investment. That's a huge thing because I've seen a lot of investors make a lot of mistakes in acquiring properties in the 1031 exchange world just to not pay taxes. I think that's a mistake. I think you'd be better off paying the taxes and having the cash and going to making a better investment versus buying a horrible deal just to defer paying capital gains taxes. So here's what I mean by that. If you're going to go into an opportunity zone fund structure, you need to make sure, and a lot of these funds that are set up, and I believe all the ones that I've seen, point to a specific property. So while it is a fund, there are going to be specific properties that that are part of that fund where your funds are going to be directed to. That's another thing that I see a big difference between opportunity zone funds and just a typical fund where you just put in money, you get a rate of return, the fund's going to go out and make whatever investments. In this structure, they're going to direct specifically where those funds are going to go because the property has to be located in a qualified opportunity zone. So it's critical that you do the due diligence on that, just like you would do due diligence on anything else, right? You got to make sure that the income and expense makes sense. Okay, now what I do see is a lot of people acquiring properties, and I just ran some sales comps here in East Oakland, and was very surprised at some of the price per square foot that I saw in office buildings that were located in the opportunity zone. In fact, I saw a price per square foot on a property in East Oakland sell higher than a price per square foot than downtown Oakland, which is an anomaly for sure. But it made me question, what's going on? Well, the reason is it's in an opportunity zone, and it was an opportunity zone fund who acquired the property. And so it kind of sold for more than it probably would have sold if it wasn't designated as an opportunity zone fund. So there's reasons for that because you're saving money on taxes. However, the pitfall, the risk is that if you overpay for something and the numbers don't end up working out, opportunity zone fund, tax deferral or not, the investment still needs to make sense. Now, a lot of opportunity zone fund investors are not worried about cash flow. They're looking at long-term growth. So that's why I'm really drilling this home. I think that if you're saying, hey, I'm just investing in this, I want to see the long-term growth. Okay, but then you got to make sure that there's something in that deal that makes it unique, something that makes it valuable, something that is going to make that piece of property in that area, grow in value. If you're investing in growth, you need to be able to tangibly point to something to see that growth. It's not just, I think it's going to go up, because it don't always work like that. And so that's number two. Make sure the deal is a suitable investment property, even if it wasn't opportunity zone. The opportunity zone, the tax deferral is the cream, is the cherry on top. You understand? Okay, and the third thing is to plan your exit. All right, these are not. Let me reiterate this. You're investing into an opportunity zone fund. This is not a short-term deal. It's a long-term situation. Many of the investors and many of the funds are planning on holding properties 10, 20 years, particularly because I'm not an expert on this. I'm not the lawyer guy on this, but my understanding is if the fund holds a particular property over 10 years, then the original investment and the gains that they've received in that 10 years are now totally, tax deferred. So meaning that the fund is going to plan on holding that investment for a while. So if you're going to invest into an opportunity zone fund structure, you need to be in it for the long haul. I think that's absolutely critical that you have that understanding going in. This can be a very good thing if you go into it with that mindset. If you go into it thinking I'm going to get cashed out in 3 years, this ain't the deal for you. Okay. Now, also the same thing with traditional group investments. Investing is a long-term play. A lot of people get into the flipping and turning over deals and making a lot of money, which is cool. But I just think that if you're going to invest, particularly with a group, opportunity zone or not, that you should be looking at it from a long-term perspective and make sure the people that you are investing with have the same mentality, because a lot of times people are looking for the quick buck, and when that doesn't happen, people give up, people get frustrated, they don't understand. If you go into it with a long-term plan and then you have something presented to you where you can make a quick windfall, go for it. But if you have a long-term plan, you can weather the storm of the markets going up and down. You can deal with the adversities that come up. And if you set it up that way, the expectations of the investors is we're in it for the long haul. That is critical. And opportunity zone funds are new, but group investing is not. It's the same idea, just a different structure. So I hope this helps. I've had some success. I've had some failures in group investing. So I want to really give what I've learned about the business to you guys, what I'm learning about group investing. I'm going to have some upcoming seminars on group investing and opportunity zone. Stay tuned for that. And I'm going to try to provide as much valuable real-time content to you guys on this topic, because I believe coming out of the pandemic that group economics, group investing, doing things collaboratively are going to be the keys to success to building our new economy. So y'all stay safe, stay healthy, and let's figure out how to work together. Peace out, y'all.